Last Friday, the core US CPI data for the month of January grew the slowest pace since March 2021, and headline CPI data came in better than expected. Overall, it led to a minor bounce in the US stock indices, but however, several mega cap technology stocks with the likes of Nvidia continues to underperform the broader market. The US dollar index continues to trend lower below its 20-day moving average for the sixth consecutive session. And last Friday, intraday US dollar gains were evaporated after the better than expected US CPI data that led to a 50% chance as being priced in by the Fed Funds futures market to indicate that there could be a potential third interest rate cut coming into the end of 2026. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. So before we kickstart today's gist of the Daily Dose, let's have a quick look at the disclaimer first. All right, give me a minute. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so today Daily Dose will be a bit special compared to the previous Daily Dose because today Daily Dose, by the end of the Daily Dose, I'll be drawing 5 lucky winners in our last welcome bonus draw for this month of February, just in time for the Lunar Chinese New Year. So 5 lucky winners will be walking away each with $888 credited to your trading account by next month. So this will come towards the end of the Daily Dose today. So do take I'll say that to stay till the end where I will be drawing these 5 lucky winners live in a while time. So as usual, before we jump straight into today's full suite of Daily Dose, which I will cover all the intraday technical outlook on all the major cross asset classes that we do on a frequent basis, let's have a recap what has taken shape last week and in early today's Asia session. So last week will be the gist of the health of, I would say that will be the gist of the inflationary trend in US, which is very important because this is one of the metrics that will guide future US monetary policy, all right, which in turn will influence global cross asset prices. So let's have a look at the data over here. So on Friday, okay, give me a minute. So hopefully the screen is good. Yeah. So on Friday, what you could see over here is that the headline CPI data, which is the data that is include energy and food, came in below expectation. So if you look at the headline inflation rate for the year-on-year basis, it came in at 2.4%, slightly below the expectation of 2.5%. And also below 2.7% print that was printed in the previous month of December. So if you look at the core inflation that strip out those volatile items like energy and food, it came in within expectation at 2.5%. And also below last month dip, which is December dip of below the December print of 2.6%. So if you look at the trend of the inflation rate over here, okay, let me share you guys the core inflation rate instead. Okay, core inflation rate. Open up the link. Okay, give me a couple of seconds. All right. So this rate of 2.5% is the lowest number if you look at from a 10-year perspective. So this 2.5% is the lowest number since March 2021 over here. All right. March 2021. All right. So what you could see over here is that since this very spike up during the inflation scare of 2021 to 2022, September 2022, US CPI inflation trend, the core one, which is stripping out all the volatile items, energy and food, is solely on the path of decelerating. So with this path of deceleration pretty much intact, that allows the Fed Funds futures traders to continue to price in at least 2 interest rate cut before 2026 ends, which is pretty much what market is expecting. So if you look at the Fed Funds futures trader behavior as being compiled by the CME Fed Watch tool, so what I could see over here is that the ongoing interest rate cut cycle so far done by the Fed, 3 interest rate cuts so far that has been done and dusted in 2020. that kickstarted in late 2025. The market participant is expecting the Fed to ease into 2026, except the fact that the fourth interest rate cut in this ongoing interest rate cut cycle will not come in so soon in March and April this year, because if you look at the current Fed funds rate, it's at 3.5% to 3.75%. So market is penciling the fourth cut to come in at the 83 or 84% chance to bring that down to 3.25% to 3.5%, the Fed funds rate, which is a implied 25 basis point cut. And the fifth cut will potentially come in on the 16th of September or on the 28th of October FOMC meeting this year, with a chance of 81% and 85% to bring the Fed funds rate down to 3% to 3.25%. But right after that, we call it encouraging CPI print that was released on last Friday to indicate that the US CPI trend is on the path of slowing down or decelerating. We have a 50% chance right now. I would say close to 50%, 49% chance, which is 50% very closely. It's a coin flip where the market participants now has priced in a potential 3 cuts that is to be done by the Fed. That means the 6th interest rate cut in this ongoing interest rate cut cycle to potentially come in on the last meeting of this year, which is the 9th of December FOMC meeting, all right, to bring it down to 2.75% to 3%. So with this ongoing, we call it market pricing of a dovish Fed, that allows the US dollar strength to remain muted. So if you look at the US dollar index over here, it continues to trade sideways. Yes, we see almost marginally no change on the US dollar index on Friday, but for the 6th consecutive session, after that first bearish reaction that was seen on 6th of February, 1, 2, 3, 4, 5, 5, 6. So for the 6th consecutive session, it continues to trade below a downward sloping 20-day moving average, acting as a near-term resistance at around 97.38. So what you could see, it means that from a technical analysis perspective, the sentiment continues to remain rather lackluster or bearish for the US dollar over here. And if you look at the stock market perspective, so from the major US stock indices, it managed to do a slight bounce away from our lower limit neutrality zone that we highlighted on Friday in my daily dose, which I stated on Friday. It managed to stage that bounce from that said lower boundary, which is the key short-term support level. So the SPX almost unchanged, 0.05%, the Nasdaq 100 0.18%, the Dow Jones 0.10%, and the top performer, the Russell 2000, 1.18%, being said that the Russell 2000 is more skewed towards a dovish monetary policy by the Fed, a higher beta one. Why? Because the component stocks in the Russell 2000 are dependent on a higher leverage ratio to improve their margin, profit margin, if we continue to see a short-term lower interest rate environment going forward. And if we see the heat map of the S&P 500, we continue to see lackluster performance in the mega cap technology stocks. That explains to us why the major US stock indices didn't stage a significant rebound in the US by the end of Friday, despite the fact that the market participants now have started to price in a third interest rate cut this year, total 6 of all, given the decelerating trend that's being seen on the US CPI data, because we see pockets of deep rate in the mega cap technology stocks driven by AI related fears, where Nvidia shared 2.21% on Friday, Google 1.08%, and Meta Platforms, the parent company of Facebook, declined by negative 1.54% over here. And if you look at the grouping, the group performance, where we see the 11 sectorial S&P performance on a weekly basis, the mega cap technology stocks going to underperform the technology, down by negative 1.19% over here. So what we could see over here is that the US stock market continues to trade in a rather sideways rangy formation, can't break out from a clear uptrending phase so far. So later I'll share you guys the key levels to watch. So over in Asia today, one more data to share with you guys will be pertaining to Japan over here. So Japan preliminary Q4 data came in below expectation, both on the Q-on-Q basis and on the annualized basis. So for the Q-on-Q basis, market is expecting a 0.4% increase, but it only came in at 0.1%. And as for the annualized basis, markets were expecting a higher blip upwards to 1.6% year on year, but it only came in at slightly lower at 0.2%. And because of this, we call it weaker than expected preliminary Q4 GDP number for Japan, that causes a negative feedback loop into the Japan stock market, where the Nikkei 225 inched down lower by negative 0.27%. And if you take into account of last Friday US session, where the futures is being traded on last Friday US session, the Nikkei 225 futures is down by a lower number, negative 1.3%, erasing off last Friday US session gain. And over in Asia, it's rather a muted session due to some key Asia stock market that will be closed for the Lunar New Year break. So Hang Seng Index is actually up by only marginally 0.23%. And bear in mind that the Hong Kong stock market will be closed tomorrow and for 3 days, Tuesday, Wednesday and Thursday, and will reopen again back on Friday, the 20th of February. So that will be the state of the Hong Kong stock market. The higher beta Hang Seng Tech Index, which comprises the mega cap technology stocks, is down negative 0.61%. And over to other Asia markets, the ASX 200 is down by negative 1.25% over here. And the China stock market is closed for a Lunar New Year break, kickstarting much earlier, where the CSI 300 and the China A50 is not trading today, and they will remain closed until next Monday, which is on the 23rd of February. And over in the rest of the Asia markets over here, in fact, the ASX 200 is up 0.2%. All right, there was a slight error just now over here. And Kospi is down by negative 0.21%, and our STI, which is very likely in a holiday mood right now, almost unchanged, negative 0.07% over here. All right, so let's sum up the first segment of the daily dose. So very quickly now, let me move on to the second segment, which covers all the intraday technical outlook on all the broad-based cross asset classes. So let me expand my screen. Okay, so let's start with the FX market first over here. All right, so the FX market, let us start with the euro dollar. Okay, so the euro dollar continues to trade sideways, but managed to continue to hold at our pivotal support at 118.40, which confirms the rising 20-day moving average. So no change. These are the key levels to watch out for. 118.40, because it's going to hold above 118.40. It doesn't make any sense for me to have a bearish bias right now. But however, the bulls got to really clear above last week high, which is at 119.27, in order to gain a much more meaningful bullish traction to revisit 119.93, followed by 120.40, which is the swing high of 28th of January, before the last round of minor corrective kickback took shape and managed to survive at the 20-day moving average on 6th of February. Only an hourly close and a bearish breakdown below 180.40 will invalidate our bullish bias and kickstart another round of choppy minor corrective decline towards the next two intermediate support level, 117.76 in first step, below 117.28, which confluence with the rising 20-day moving average. Next up will be the sterling against the dollar. So the pound continues to trade higher above our 135.88 short-term predefined pivotal support previously, but still can't break above our upside trigger level at 136.67 highlighted earlier. So no change in terms of the level. One thing encouraging is that the price action of the dollar, price action of the sterling against the dollar has managed to reintegrate back above the 20-day moving average. So with the upside trigger level remains the same at 136.67, we will potentially maintain our mild bullish bias. A clearance above 136.37 will allow the momentum, the bullish momentum, the intraday bullish momentum to gain better traction to expose the next intermediate resistance zone at 137.30, 137.50, followed by a retest on the 28th of January and 29th of January swing high area at 138.48. Only a bearish breakdown below 134.88 and an hourly close below it will invalidate our mild bullish bias for the sterling dollar to see another round of choppy minor corrective decline to retest the 6th of February bullish reversal, minor bullish reversal low a minor bullish reversal low area, which confluence at 135.08, and which is at 135.08. That's confluence with the rising 50-day moving average. Only a breakdown below 135.08 will see a deeper minor corrective decline towards 134.55, which is coming very close to the key 200-day moving average. So that's for the sterling dollar. Next will be the Asia Pacific currency. Let me expand my screen. So that will be the Aussie dollar over here. So the Aussie dollar managed to do a bit of whipsaw at our pivotal support at 70.65. But what we could see over here is that the hourly momentum has started to turn rather encouraging for the bullish side of the story, as it managed to stage a bullish breakout above a former descending trend line resistance. Retested it in today's Asia session before shaping a higher high. So indicating that bullish momentum is creeping back into the Aussie dollar again. So with that, we will have a bit of access on last Friday swing low area, which is at 3 p.m. Singapore time, and which is also the low of this bullish hourly candlestick that is formed at the 3 p.m. mark Singapore time at that point in time. So that will be 70.40. So a bit of access 70.40. So 70.65/70.40 will be my pivotal support level for today. Maintain this bullish bias going forward on the Aussie dollar. First resistance level to watch will be at 71.40. A clearance above 71.40 will increase the probability of another round of bullish impulsive uplift on a minor time scale to expose the next intermediate resistance level at 71.75, followed by 72.10, 72.19, which is a bunch of Fibo extension cluster level, and also the upper limit of this potential ongoing minor ascending channel drawn from the swing low of 6th of February and 13th of February. All right, so that's for the Aussie dollar. Only a bearish breakdown below 70.40 will invalidate this start of this mild bullish impulsive upmove sequence to see the extension of the minor corrective decline, exposing the next near-term support level at 69.80, which confluence with the rising 20-day moving average. So that's for the Aussie dollar. Next up will be the dollar yen. So dollar yen continues to trade sideways, holding below our short-term pivotal support that we have on last Friday, 153.85. So what I could see over here is that the dollar yen, pardon me, let me repeat everything again. So the dollar yen continues to trade below our short-term pivotal resistance that we have on last Friday, 153.85. But from a price action perspective, since the spike up of 153.85 can't have an hourly close above it and starts to trade in a sideways fashion. In this side fashion, it seems to us that the high are getting lower. We see a series of minor lower high over here. Let me link it up. All right. And we see a series of almost similar low. Okay, over something like that. Okay, almost a series of similar low. So this, in terms of chart pattern, is a potential minor descending triangle, which implies a bearish consolidation movement that is still unfolding on the dollar yen right below a downward sloping 20-day moving average, indicating that the trend has started to turn downwards as well from a short-term perspective. So with that, no change in terms of the levels, maintaining my bearish bias 153.85, but price action got to break down fast below 152.20, which is very close to the lowest point of this ongoing minor bearish consolidation pattern, which is a minor descending triangle, and also confluence with the minor swing low of 28th of January 2026 as well at 152.20. A bearish breakdown below 152.20 will indicate a bearish breakdown scenario from this minor descending triangle configuration to potentially expose the next near-term support level at 151.20, which is the minor congestion area of 13th of October and 21st of October last year. Only a sudden push-up above 153.85 will invalidate today's bearish bias view on the dollar yen to see a squeeze up to test the medium-term pivotal resistance level that is now at 154.65. All right, so that's for the dollar yen, and also sum up all the intraday technical outlook on the broad-based dollar on the 4 major US dollar pair. So let us now proceed with the major stock indices. All right, starting with the Hong Kong 33. Okay, so the Hong Kong 33 managed to bounce up from our lower neutrality zone that we have on last Friday and is now fast approaching the upper limit, which is at 26,905. So given the fact that the Hong Kong stock market will be closed starting from tomorrow all the way until Thursday, which is 17, 18, 19, and will reopen back again on Friday, which is on the 20th of February. All right. So given that this lower liquidity during the Chinese New Year break, I will not be so aggressive to have an intraday bullish bias for today. So still remaining our neutrality stance between 26,285 and 26,905. We saw the 20-day moving average, I think, as an intermediate resistance. Only we suddenly see a bullish breakout at 26,905, then potentially we may see a mild bullish bias view to seek a retest at this all-important 27,500 major resistance level on the Hong Kong 33. So why 27,500 is a major resistance level? Let me have a quick recap for you guys again, for those who have missed it earlier. So look at the weekly chart of the Hong Kong 33, which I plotted on my screen over here. So this 27,500, pardon me, 27,500 has been tested 4 times since 29th of September 2025. Tested it again on 17th of November 2025, and tested it again most recently on the week of 26th of January 2026 and the 9th of February 2026. Several times, 1, 2, 3, 4, 5, fifth time, and this 27,500 also confluence with this gray line here, which is this long-term descending trend line that has been in play since its January 2018 all-time high that was printed previously on 29th of January 2018 at 33,495. So hence, if we are able to see a clear bullish breakout, not an intraday break, that means a breakout with a weekly close. So you realize that in the previous week of 26th of January and as well as now of February, it did an intraday break, but it didn't have a weekly close above it. So with a weekly close above 27,500, it will increase the probability that the transition of the Hong Kong 33 into a potential major multi-month uptrend phase that potentially could be in play if we start to see a weekly close above this all-important major resistance level at 27,500. All right, so now back to the Japan 225 on the intraday basis. So Japan 225 in today's Asia session, it gave up last Friday US session gain over here, but managed to continue to hold at the pivotal support zone that we have previously, 56,990, 56,534. So still no change to use this pivotal support zone to have a mild bullish bias unless we have a clearance above 57,935 upside trigger level that we also highlighted on Friday, where it can't surpass above it. Clearance above 57,934 will increase the odds of another round of bullish impulsive upmove sequence that is in play for the Japan 225, representing the Nikkei 225, to potentially see the next intermediate resistance coming in at 58,932 in the first step. Only a bearish breakdown below 56,534 will invalidate this recovery scenario and see the minor corrective decline sequence extending further, exposing 56,096 in the first step, below 55,000, before that, thereafter 55,111, 54,790, which confluence with the rising 20-day moving average. And this level here is a very important pullback support level, because previously it was the all-time high that was printed in 14th of February and 15th of February, got a bit of hurdle that is being seen on 3rd of February and 4th of February before that steep bullish breakout takes shape. All right. And this level here, I'll be on the lookout for a bullish reversal candlestick pattern to switch my bias back to the bulls again, given that price action is still going to hold above the 20-day and the 50-day moving average. Next up will be the Germany 30, that's representing the German DAX. So Germany 30 continues to trade at the 20-day moving average, staging a slight bounce from last Friday. Hourly RSI continues to remain constructive as managed to see a series of higher low, indicating that some form of bullish momentum still remains intact. So given that it can't clear above the first resistance zone of 25,260, which was the high that was printed on last Thursday, I don't want to have a very tight short-term pivotal support level for today at 24,847. So I'll maintain the same at 24,610, which confluence with the rising 50-day moving average as well. Only a bullish breakout and an hourly close above 25,260 that I will tighten the pivotal support to 24,847. Above 25,260, potentially see a retest on the current all-time high area at 13th of January this year at 25,505. Only a bearish breakdown below 24,610 will invalidate today's mild bullish bias to see it drifting downwards again, a choppy corrective decline to retest this potential double bottom low area at 24,250, which is all confluence very closely to this up and coming rising 200-day moving average. So that's for the Germany 30. Next will be the major US stock indices, starting with the US Wall Street 30. So US Wall Street 30, last Friday, we have a neutrality stance between 49,940 and 49,265. So given this positive observation after it bounced off from the 20-day moving average and formed a higher low, and upon retesting the 20-day moving average, the hourly RSI has a pre-bullish condition signal by flashing out a higher low, which is a bullish divergence signal, indicating that the prior downside momentum that was seen on last Thursday has started to ease off. So with this positive observation that I highlighted earlier, I'll be using 49,265 as my short-term pivotal support level for today. Do have a mild bullish bias heading into today and tomorrow, with the first resistance coming in at 49,940. Only a bearish breakdown below 49,265 will invalidate today's intraday bullish biasness to see it drifting downwards lower at 48,900, 48,710, which confluence with the rising 50-day moving average. And bear in mind that today there will be potentially lesser liquidity in the US stock market, given that the cash US stock market will be closed today on Monday, 16th of February, for a public holiday in the United States. Next will be the SPX. So the SPX also traded with a higher low after testing the lower limit of this neutrality zone that we highlighted earlier. But it's still much weaker than the Dow Jones Industrial Average, given the fact that it's still trading below the 50-day and the 20-day moving average. So with that, we will have a mild bullish bias for today using 6,797 as my pivotal support level, given the fact that the momentum also has the downside momentum on Thursday has started to ease off by the appearance of this bullish divergence that's being seen on the hourly RSI. First resistance level to watch on the SPX 500 will be 6,877. Above it, potentially seek out the next intermediate resistance zone at 6,916, 6,932, which confluence with the 20-day moving average. However, a bearish breakdown below 6,797 will invalidate the mild bullish bias and see further potential weakness to expose 6,769 and potentially even the medium-term pivotal support zone at 6,733, 6,720, which is the minor swing low of 6th of February and the swing low of 18th of December last year. So that's for the SPX. Lastly will be the Nasdaq 100. So Nasdaq 100 also printed out a bullish divergence as well. So with that, it managed to find support at the lower limit of the neutrality zone that we highlighted earlier. So using 24,580 as my short-term pivotal support level for today, do have a mild bullish bias on the Nasdaq 100. First resistance level 25,085. Only a bullish breakout above 25,085 will potentially see a much more intraday bullish traction to retest the area of the 20-day and the 50-day moving average. I think as a resistance around 25,430. All right, 25,430. Only a bearish breakdown below 24,580 will expose further weakness towards 24,333 and potentially a retest at the key 24,140 medium-term pivotal support level, and also confluence with the rising 200-day moving average as well. So that's for the Nasdaq 100. All right, so that sum up also the intraday technical outlook on the major stock indices. Let us now touch on the commodities market, starting with the precious metal, gold XAU/USD. So gold continues to have this kind of rather sideways rangy configuration. Still can't break above the pivotal resistance at 5,170 for the third occasion on last Friday as well. And what we could see now is starts to shape a lower high over here. All right, indicating the lack of bullish momentum as it continues to get congested in this complex sideways range configuration since the minor bullish reversal low of 2nd of February. So with that, we still have a mild bullish bias going forward inside this very complex sideways range configuration, using for sure 5,170 as my short-term pivotal resistance level. First support level, it got to break below to gain more bearish traction on the intraday basis, will be at 4,898, which is the minor swing low that is formed on Friday Asia session. A breakdown below 4,898 may expose the minor swing low area of 6th of February that confluence with 4,795, 4,703, and that confluence with the rising 50-day moving average as well. Right. However, a bullish breakout and hourly close above 5,170 that would invalidate this mild bearish bias and see a squeeze up to retest 5,448 and even the current all-time high at 5,602 that was printed on 29th of January. Right, so that's for gold XAU/USD. Watching very closely this 5,170 short-term pivotal resistance level for gold XAU/USD that potentially continues to trade within this very complex range configuration, and potentially a breakdown below 4,898 will expose the lower limit of the range in first step at 4,795, 4,703. Lastly will be the West Texas crude oil over here. So the West Texas crude oil, we continue to see some form of we call it stabilization after that plunge that was seen on Thursday at the key 200-day moving average and 20-day moving average, key 200-day moving average and 20-day moving average confluencing at 62,000.38. And what's interesting over here, this stabilization of similar lows has come in the form of a higher low as being seen on the hourly RSI, and the hourly RSI so far has did a bullish breakout during today's during last Friday US session over here at 1 a.m. Singapore time on which is on the Saturday, and see a series of higher low, so indicating there is some form of bullish momentum resurgent back into the, let me expand my chart, some form of minor bullish momentum that is resurging on the West Texas oil. So with that, I will have a mild bullish bias today using 62.38 as my short-term pivotal support level. First resistance level to watch will be 63.92 over here. Let me put it in writing. 63.92. Okay, above 63.92 will allow it to retest this minor range resistance that has been in place since 5th of February, got rejected on 11th of February at 65.62. Only a bullish breakout above 65.62 will increase the odds of another round of minor bullish impulsive upmove sequence for it to expose the next intermediate resistance zone at 66.50/66.85, followed by 67.80. Only a bearish breakdown below 62.38 will invalidate this mild bullish bias to see an extension of this minor corrective decline sequence, exposing 61.12/60.64, which is confluencing with the rising 50-day moving average. Below it exposes the medium-term pivotal support level at $59 per barrel. All right, so that's for West Texas oil, flipping to a mild bullish bias today using 62.38 as my short-term pivotal support level. So before we go through the live lucky draw, let's take a look at the economic calendar first. of what are the key data to look out for today. All right. So like I mentioned, today will be a quiet US session because of the closure of the US public stock market today due to a public holiday. So European session will be pretty much quiet as well. Only one tier 2 European data to take note of will be at 6 p.m. Singapore time, Eurozone industrial production year-on-year for December. So that could in some form influence the euro dollar, the euro crosses, and the Germany 30 CFD index. So at 9:25 p.m., we have one Federal Reserve official speaking, Fed Bowman, and thereafter will be no key events or data. Right. So for those who are pretty much keen on the Aussie dollar, we know the Australian market is still open because as they don't have a public holiday for Chinese New Year. At 8:30 a.m. Singapore time, 17th of February, which is the first day of the Chinese Lunar New Year, 8:30 a.m. Singapore time, we have RBA meeting minutes. So this is rather important, given the fact that we know that RBA is the first central bank exiting out from its interest rate cut cycle and heading into and hike its interest rates over here, other than the Bank of Japan, which is a rather outlier. So market participants will be scrutinizing the discussion on the meeting, potentially looking out for more hawkish vibes among the RBA officials. So if that is being firmed up, that could potentially see a support in this ongoing minor and medium-term uptrend phase on the Aussie dollar, watching out the key resistance level at 71.40, which I highlighted earlier on. All right, so that sum up the key events and data to look out for today and as well as in tomorrow early Asia session, 17th of February. So right now, very exciting. Let us now start the lucky draw for the 5 lucky winners in our welcome bonus draw that were able to win 888 each to be credited in your respective trading account. So before that, let me get the lucky draw get started over here. So hopefully the screen is good. All right. Let me shift the screen over here. All right, so let us get started. Okay, so I think everything is fine. Okay, so let us start with the draw over here. We'll be drawing 5 lucky winners. All right, so these 5 lucky winners each were able to get a $888 credited into your trading account by next month, and all winners will be notified by email within 1 week from today. So let us start with the first lucky winner. All right, ready to go. All right. Okay, big congratulations to ID 93843FB. Big congratulations to you. All right. Let us now draw our second winner. Who will it be? Okay, congratulations to ID 46E8936F. Big congratulations to you. Okay, now let us draw our third winner. All right, congratulations. We have the third winner with the ID of C6C9A1066F. All right, so 2 more lucky winners to go. So who will be our 4th lucky winner? All right, so who will it be? Okay, here we go. Okay, congratulations to ID 3004D61F. All right, so right now we will have our last lucky winner, the fifth winner, to able to have this $888 credited to your trading account. So let's see who is the last lucky fifth winner. Who will it be? All right, so here we go. All right, big congrats to 9590-193 DFB. All right, so all winners will be notified by email within 1 week, and you're able to have the $888 credited to your trading account by next month. So thank you for those who participate in this monthly welcome bonus draw, where we have this draw for 3 times. So this will be the last time, but do look forward for more promotion and bonuses in the coming month. And for those who are celebrating our Chinese Lunar New Year, I wish you all a prosperous with great abundance in the year of the fire horse. 恭喜发财 and 马到成功. Right, we shall speak again on next Monday, as I'll be off for a Lunar New Year break, and do have a restful and wonderful Chinese New Year celebration. And we shall speak again on next Monday, the 23rd of February. Thank you.